Thank you, and good afternoon, everyone. Like some of the other speakers, let me firstly thank the organizers for putting this on and inviting Standard Chartered to be one of the sponsors. It's the first year we've done this, so we're thrilled to be here and welcome the opportunity to address you. I thought I'd make some comments around the general topic of emerging markets in sort of three sections. Firstly, why do I care, and why does Standard Chartered care? Because I'm not sure many of you are familiar with Standard Chartered, so I'll briefly tell you why I think we care about this topic, and then switch to why I think you may wish to care about emerging markets. And thirdly, touch on some of the issues and challenges that I think we all face in dealing with the emerging markets, but also touch on some of the opportunities. So let's start with why do we care, and I start in 1850. In 1850, the two biggest economies in the world were India and China. China was the biggest, India second. And in 1850, those two emerging, well, they weren't emerging then, but they are now, those two economies accounted for 40% of world GDP. So in 1853, a bank was set up called the Chartered Bank of India, Australia, and China, based in London, to bank trade and investment flow between UK, Europe, and Asia. And we opened in Shanghai in 1858 and in Calcutta in 1858. In 1862, another bank was opened in London called the Standard Bank of British South Africa to bank trade and investment flow between Europe and Africa. And essentially, here we are 160 years later. We can't be very imaginative because our strategy hasn't changed a whole lot. We're all about banking trade and investment flow in and out of Asia, Africa, more recently the Middle East. So that's our roots, our heritage, and it's pretty obvious why we should care about the emerging markets. But let me switch to perhaps you might want to care about the emerging markets. And let me firstly talk about GDP. For about the last 10 years, the emerging markets have represented roughly 1/3 of global GDP, but roughly 2/3 of growth in world GDP. So we currently, the emerging markets are about 40% now, having had this higher growth rate. It is slowing a little bit, so the growth rate in the emerging markets in 2013 was 70% of overall growth in GDP. Last year it was 61%. We think this year it'll be about 54%. So still a significant part of the global growth in GDP is the emerging markets. There's some fragility in these markets. People talk about the debt issues, current account debt issues in Indonesia, Brazil, Turkey, India, South Africa. So there are those issues, and they've slowed a little bit. China has slowed, and I'll touch on China in a bit more detail in a minute. But overall, though, the picture is still the same, that the emerging markets are growing faster than the developed world. In terms of the relevance, again, why you may wish to care about this, if I switch to trade and look at the rate of growth of trade, coupled with the rate of growth of GDP, trade between developed markets, so if you take Europe as a block within Europe or between Europe and the US, developed world countries, trade has been growing at about 6%. Trade between developing world and developed world has been growing at about 12%, so twice the rate of growth with the developing world as we've been enjoying within the developed world. Developing world to developing world is growing at about 20%. So just to give you an idea of how these trade flows are shifting. And the emerging markets is now 42% of world exports. And that's up from 19% in 1990. So a pretty dramatic growth in trade, and in particular, trade with the emerging markets. And let me talk about the relevance and importance of the EU with the emerging markets. As of 2013, the EU is China's biggest single trading partner. And after the US, the EU is US's biggest trading partner. So the trade corridors between Europe and Asia are significant. In terms of Africa, they dwarf the other trading corridors. The EU's Africa's biggest trading partner by far in both directions. It's about 35%. And we account for about 40% of sub-Saharan agricultural exports. So in terms of relevance, EU is highly relevant to the trade corridors of both Africa and Asia. And let me touch on a couple of countries in a little more detail. China, because there's a lot of discussion around China, I know. And it is slowing. It slowed from around 8% growth last year, just over 7% growth. We think this year, again, around 6.8 to 7% growth. So it is slowing. Total credit in the public and private sector, total credit is now 250% of GDP. So that's not necessarily a good thing, but it is stabilizing. The property development sentiment is such that we don't believe there will be a bubble as such. There has been some inflation, but we don't think that it's going to be a bubble. But I think generally with China, we need to get used to having China growing at 5, 6, maybe 7%, not the 8 or 9% growth that we've seen historically. But when you sit in a world in Europe where growth is 1% or 1.5%, then you look at the growth rates in China and it still looks very attractive. And you couple that with the trade, the growth in trade, then I think there's a lot of opportunity still for Europe to do more business in China. Let me touch on a sort of byproduct of this China growth, and that's the offshore renminbi. So this is transactions denominated in renminbi instead of other currencies. And in 2010, in December, Standard Chartered launched an index called the Renminbi Globalization Index, because we could see a rise in transactions denominated in renminbi. We wanted to measure that growth. And we set the index that year, or that month, at 100. And last month it was 2,100, which means in 4 years and 3 months, we've had 21 times the volume of transactions denominated in renminbi. And this is across trade, payments, foreign exchange. So a significant shift. The renminbi is now the 5th largest trading currency, payment currency, and it just overtook the euro. It's now the 2nd currency for denomination of trade. So this is a pattern that is, I think, going to continue. It's a trend that's going to continue. This is not a cyclical thing. And the US accounts for 9% of world exports. The US dollar accounts, in terms of the currency of denomination, 81% of world exports are still in US dollars. But if you're exporting commodities from Africa to China or oil from Russia to China, you don't necessarily need to go through the US clearing system with a transaction denominated in dollars. The London Metal Exchange, now you can do contracts denominated in renminbi. You can post margin in renminbi. And as soon as commodities start to reprice in a currency other than dollars, I think you'll see a pretty significant shift in the use of renminbi in foreign markets, which I say is a bit of a byproduct of what's going on in China, but it is quite a significant shift. And in London, we see London as being a major offshore center dealing in offshore renminbi, the second most important after Hong Kong. Let me touch on India briefly, because that's, I think, another one that people have been focusing on. The new Modi government is very active looking at pro-business reform, so we're very encouraged about that. The GDP growth projections for this year have been revised upwards to 6.6% from 4.7%. So again, I think that's an encouraging sign. Quite tough to get all the reform done in India, frankly, that needs to get done. The government only has a majority in the lower house, not the upper house, so that constrains them. But there are quite a lot of quick wins, I think, around VAT, improving electrical supply. So a lot of small steps that I think can help. So in the medium long term, as I say, we're quite encouraged by what we see going on in India. So let me switch to some of the challenges and issues. And I think part of the problem with this discussion is emerging markets are not homogeneous. So when you look at the challenges, they all have common challenges. Their ability to deal with them and their effectiveness in having dealt with them varies quite considerably. So I think across Asia, we tend to be pretty encouraged by what we've seen in terms of reforms. I think we're less encouraged when we look at Brazil and Russia. So some of the BRIC countries, I think Brazil and Russia not doing as well. India and China, I think, are doing pretty well. But reforms have really been fairly significant since the 90s, the 80s and 90s. And part of that, I think, was driven by the Latin debt crisis and the Asia debt crisis. So we've just gone through our financial crisis, but in Latin America, that happened in the 1980s. In Asia, that happened in the 1990s. And that drove a lot of reform, particularly of the banking system. So when you look at and in the public financial arena, if you look now then at public debt, they really had to do some major transformation in Latin America and Asia after those crises because they'd got a lot of dollar debt that was not supported by a dollar basis to repay it. So much of the debt now is in local currency, not dollars. So in general, I think it's a much better picture than it was. Oil is an issue. Some good news, some bad news. For Nigeria, Russia, not particularly good news. But for many of the emerging markets, low oil prices is really giving them a boost. So we see that as generally a positive factor. Let me sort of finish on, so what does all that mean for the EU, and what should the EU do about the emerging markets, if anything? And I think there's two things the EU can do and one thing the EU probably shouldn't do. So the two things I think the EU can do is promote trade and do more around the trade agenda. The UK government has set a target for exports to double between 2011 and 2020 to $1 trillion. But to put it in perspective, only 1 in 5 companies in the UK currently exports. In Germany here, it's 1 in 4 companies. But the UK still exports more to the Republic of Ireland than we do to Brazil, Russia, India, and China combined, just to sort of put it in perspective. So there's a lot that can be done there. But I think supporting trade agreements, TTIP, I know that's Europe and the US, but we think that will add about 10 billion to the UK economy, 100 billion to the EU economy, 85 billion though to other economies, 80 billion to the US, but 85 to other economies. So I think TTIP is an important one to get over the finish line. But there's other EU, ASEAN trade agreements under discussion, and I think it'd be great if we can conclude those. If we just look at the EU-Korea free trade agreement that was signed in 2011, in the following year, the value of UK exports to Korea went up 40% as a result of that free trade agreement. So a cheap euro clearly helps a lot of the countries here, but getting some of these free trade agreements in place, I think, is important for the growth of domestic Europe because of the export potential. Secondly is on investment. So I think we've got opportunities on trade, but also on investment. And I'll mention Africa in that regard. I haven't really talked much about Africa yet, but the biggest need in Africa is power. If you look at the continent of Africa, you can fit inside it from a landmass point of view, the EU, the US, and China. That's how big a landmass it is. It has the grid wattage of Belgium. So just to give you a sense of the power challenge and how much investment is needed, because without power, you can't really get the industrialization and urbanization. The US government is committed to a 20 billion Power Africa project. We've committed 5 billion of our own bank funding towards projects in Africa, but I think there's a huge opportunity for corporate Europe to do more in inward investment into Africa to spur those economies. And again, given the 35% bilateral trade flows between Europe and Africa, I think that's helpful as well. The caution I would give, and the thing that I wouldn't suggest the EU does, is impose regulation on other countries, particularly on the emerging market countries. And we've seen some sort of extraterritoriality